Breaking news. Global markets in turmoil, fears of a new banking crisis, lines outside ATMs. Imagine waking up, going to the ATM, and seeing, transaction denied. You check your app, your balance is gone, or frozen, a digital mirage. You think, this can't happen here, Basecrommers. But it already has, in countries just like ours. There's a pattern in financial history that's destroyed millions of savings in the last 15 years. And in 2025 the legal framework is in place for it to happen in the United States. The rules are already on the books. The question isn't if, but when. We'll break down 3 real-world examples where the system turned on its own people, legally seizing their savings, from Cyprus, to Greece, to Lebanon, and then back home to your bank account, because what you don't know can hurt you. Let's get after it. Cyprus, March 2013. A small island nation in the Mediterranean, known for its sun-soaked beaches and vibrant culture, was about to become the epicenter of a financial earthquake that would send shockwaves across Europe and beyond. Cyprus had built a reputation as a banking hub, trusted by Europeans and Russians alike. Billions flowed through its financial system, making it a magnet for international investors and everyday savers. The banks seemed solid, pillars of stability in a turbulent region. People deposited their life savings, confident their money was safe. But beneath the surface, cracks were forming. Cypriot banks made risky bets on Greek debt, lured by the promise of high returns. They invested heavily, tying their fate to the fortunes of their neighbor. When Greece defaulted, the consequences were catastrophic. Cyprus was left insolvent, its banks suddenly teetering on the edge of collapse. The government, desperate to avoid disaster, begged Europe for a bailout. The stakes were nothing less than national survival. The answer from Europe was cold and clear. We'll help, but you must find $5.8 billion yourself. The solution they proposed was unprecedented and deeply controversial. Take it from the people's bank accounts. For the first time, ordinary depositors would pay for the bank's mistakes. On a Friday, life was normal. People went about their routines, unaware that their financial world was about to be turned upside down. By Saturday, banks were closed, transfers frozen, ATMs ran dry. The entire financial system ground to a halt, leaving millions in limbo. The country's financial heart stopped. Businesses couldn't pay suppliers, families couldn't access their savings, and uncertainty gripped the nation. The plan was simple, but brutal. Seize a percentage from every account, big or small. Panic erupted as people realized their hard-earned money was at risk. Parliament rejected the first plan, bowing to public outrage. But the banks stayed closed, and the crisis deepened with each passing day. The European Central Bank threatened to cut off all liquidity, raising the specter of total financial collapse if a deal wasn't reached. A new plan emerged: protect accounts under $100,000, honoring the promise of deposit insurance for most citizens. But anyone above that threshold lost nearly half their savings overnight. For many, decades of work vanished in an instant. Small business owners, retirees, families, wiped out. The impact rippled through every corner of society, sparing few. Their money was converted into near-worthless bank stock, a cruel trade for what was once considered safe savings. This was a bail-in, not a bailout with taxpayer money, but a direct seizure of depositors' funds to rescue the banks. When you deposit money, you're not just a customer, you're an unsecured creditor. Your funds are a liability for the bank, not a guarantee. In a crisis, you're at the bottom of the food chain. The shock was profound, and the sense of betrayal ran deep. Trust in the system shattered overnight. People questioned everything they thought they knew about banking. People rushed to pull out what they could, buy gold, stash cash at home, anything to protect themselves from the next shock. The economy was devastated for years. Businesses closed, unemployment soared, and recovery was painfully slow. This wasn't a robbery by criminals, but by law. The rules had changed, and the people paid the price. The government, backed by Europe, rewrote the rules overnight. Deposit insurance, once seen as a safety net, was exposed as a fragile promise. In Cyprus, it became just a dividing line. Most were spared, but many lost everything above the threshold. The sense of injustice lingered. The lesson was clear. In a crisis, the rules can change instantly, and no one is truly safe. Your savings are only as safe as the system's stability. When trust is lost, the foundation of banking crumbles. Cyprus set the precedent. Depositors' money is now a tool to resolve banking crises. The world was watching, and the message was chilling. The trust that underpins banking can be shattered in a blink. Years of confidence can disappear overnight. The promises made in good times can be broken in emergencies. What was once unthinkable became reality. The legal framework can be weaponized against you. Laws, meant to protect, can be rewritten to take. This was just the beginning. The midnight heist in Cyprus changed the rules for everyone, everywhere. 2 years after the shock in Cyprus, the financial crisis struck Greece with devastating force. But this time, it wasn't a sudden overnight seizure of funds. It was a slow, suffocating squeeze that tightened day by day, week by week. By the summer of 2015, Greece was teetering on the edge. Years of harsh austerity measures had already crippled the economy, leaving businesses shuttered and families struggling to get by. The Greek government found itself locked in a bitter standoff with its creditors. The European Central Bank threatened to cut off emergency funding, raising the stakes to a breaking point. The government's response was drastic. Banks slammed their doors shut, and capital controls were imposed almost overnight. Suddenly, ordinary Greeks could only withdraw $60 a day from ATMs, no matter how much money they had in their accounts. It didn't matter if you had $6,000 or $6 million. Everyone was trapped in the same invisible cage, their financial freedom instantly curtailed. Imagine trying to pay your rent, buy groceries, or cover your bills, forced to survive on just $60 a day with no end in sight. Every day, long lines snaked outside ATMs. People waited anxiously, hoping the machines wouldn't run out of cash before their turn. The banks remained closed for 3 agonizing weeks, as the days dragged on and uncertainty grew. But the capital controls didn't end there. They lingered for years, casting a long shadow over daily life. With cash so scarce, the economy began to revert to barter and IOUs. Small businesses, already on the brink, collapsed in droves. A black market for cash exploded as desperate people sought any way to get their hands on physical euros. The psychological toll was immense. Anxiety and fear became part of daily life, as people worried about how they would feed their families or pay for medicine. People could see their money on a screen, but it was untouchable, locked away by invisible barriers. Elderly pensioners wept outside shuttered banks, unable to access their life savings for food, rent, or vital medicine. What began as a financial crisis quickly became a humanitarian one, as families lined up for aid and basic necessities, and all of it was perfectly legal, enforced by emergency decree, passed in the halls of parliament. Unlike Cyprus, this crisis didn't just target the wealthy or the few. It hit everyone, young and old, rich and poor, families and businesses alike. The government didn't seize your funds outright, they simply denied you access, locking you out of your own money. By controlling the flow of money, the authorities controlled the people, dictating the pace and limits of daily life. Financial freedom vanished overnight. The state now dictated your economic existence, deciding what you could spend and when. Even after the banks finally reopened, the restrictions didn't disappear. For years, Greeks lived with limits on withdrawals and transfers. Transfers abroad were blocked, new accounts were forbidden, and international business ground to a halt. For more than 4 years, Greece lived under what many called financial martial law, a constant reminder of how quickly freedom can vanish. The lesson was clear. A bail-in isn't the only weapon in the arsenal. There are other ways to control a nation's wealth. Capital controls can freeze an entire country's wealth, trapping millions in a financial cage. Your bank account, once a symbol of security, can become a prison, overnight and without warning. If Cyprus was a swift strike, a sudden jolt to the financial system that left many reeling, and Greece a slow squeeze, a gradual tightening of the economic noose, Lebanon is a financial black hole, an abyss from which no light escapes. The crisis began in 2019 and still hasn't ended. It's as if the country is on a permanent bank holiday, a never-ending pause. Lebanon's banks once promised safety and high returns, luring in customers with the allure of prosperity. In reality, it was a Ponzi scheme. Banks paid high interest with new deposits, a house of cards waiting to collapse, while lending to a corrupt government, a partnership built on shaky ground. When the system collapsed, people rushed to withdraw savings, a frantic scramble for what was rightfully theirs. The banks simply locked their doors, shutting out the hopes and dreams of countless individuals. When they reopened, they imposed informal capital controls. No law, just collusion, a silent agreement to withhold. Withdrawals were limited to a few $100s a week, then a month, a slow drip of what was once a steady stream. Lebanon's dual currency system made things worse, a tangled web of financial confusion. Dollar accounts became lollars, phantom dollars on a screen, an illusion of wealth. Banks refused to give out real dollars, a refusal that shattered trust, forcing withdrawals in local currency at a fake exchange rate, a cruel twist of financial fate. People lost 90% or more of their savings overnight. The freeze became permanent, a chilling reality. For 6 years, Lebanese have been locked out of their life savings, a prolonged nightmare with no end in sight. The middle class was wiped out, a once thriving segment of society reduced to survival mode. Desperation led to lawsuits, and even bank holdups by depositors demanding their own money, a desperate cry for justice. The legal system was paralyzed, unable to provide the relief that was so desperately needed. The banks, backed by the central bank, rewrote the rules to save themselves, a self-serving rewrite of reality. They simply decided your dollars weren't dollars anymore, a decision that erased dreams, billions in private wealth erased, a vanishing act of epic proportions. The ultimate vulnerability. If the system is corrupt, the very foundation of trust crumbles. Banks don't even need new laws. They just stop honoring obligations. A silent betrayal. Lebanon is the worst-case scenario. A freeze that never thaws. A chilling testament to financial failure. Your savings are only as real as the bank's willingness to return them. A fragile promise. When trust breaks, your wealth becomes a ghost, a haunting reminder of what was lost. Lebanon is a stark warning. The social contract can be broken, a cautionary tale for the world, and the money is gone for good. A sobering end to a tragic story. Cyprus, Greece, Lebanon, 3 countries, 3 mechanisms, same result. Depositors lost access to their money, all legally. The US has the same legal framework. The next crisis could put your savings at risk. You might think, that can't happen here. We have the FDIC. But deposit insurance is just a line in the sand. The Dodd-Frank Act codifies bail-ins. Depositors are unsecured creditors. Capital controls. In a crisis, the government could freeze transfers and limit withdrawals. The point isn't to scare you, but to arm you with knowledge. The financial system is built on confidence, but history shows the rules can change to protect the system, not you. Understanding bail-ins and capital controls is the first step to financial resilience. The real question isn't whether the system is safe, but what you'll do if it isn't. The pattern is there for all to see. Are you willing to look? Because what you don't know can cost you everything.